The conventional wisdom is that institutional money moves the market. And retail individual traders have historically been regarded as a contrary signal, as in when the masses get excited about the investment opportunity, it is actually time to exit. But the most recent market rally was different. It sparked speculations about the increased role of retail traders in market moves. So can millennials bored in quarantine, gambling using zero-commission trading apps, actually move the market and compete with professional investors? US equity market volumes have been remarkably high since March 2020, and the composition of that volume has started changing. Retail participation has been growing rapidly, driven by several factors. First of all, last year, most of the major brokerages introduced zero commission following Robinhood. Interest rates have been at historical lows. With so little money to be made on bank deposits and bonds, stock market has become an attractive opportunity for individual investors. Investors likely viewed market downturn as an opportunity to pick up some stocks at a cheap and then benefit on the recovery. Many retail brokers introduced fractional trading, which made it even more affordable for new investors to enter the market. People have been working from home or not working at all. They got bored and frustrated, and they craved an extra dose of dopamine, which trading apps seem to provide. Since brokers started replacing their lost revenue on the commission with other revenue streams that are volume-based, they've been on a mission to recruit as many new customers as possible. They mainly target millennials, so they create slick user interfaces, instant account opening, and more importantly, they use a lot of elements of gamification. Day trading actually resembles gambling quite a bit, except it is perfectly legal and now it is also completely free. In the professional investment circles, retail traders are often being referred to as uninformed investors. For the most part, they don't bother looking at companies' balance sheets or trying to figure out discounted cash flow analysis. They just view volatility as an opportunity to make easy money, and a lot of times they just trade for fun. And that is exactly why retail brokerages were able to offer them zero commission trading. Very few, if any, retail orders actually go directly to an exchange. Instead, retail brokerages sell retail order flow to market makers. According to the most recent disclosure, market makers paid Robinhood $100 million in the first quarter of this year for order flow, and those payments nearly doubled from January to March. Payments for order flow is not a secret at all. At this point, everybody knows about it. But oftentimes it is being presented as a pure evil, which is not necessarily the case. In equity markets, there are two types of orders: liquidity providers who place limit orders at a specified price or better, and liquidity takers that trade at posted prices. Now, liquidity providers are for the most part professional market makers, and they try to set a spread tight enough to trade, but at the same time wide enough to make sure they don't get hurt if the price moves significantly. Now, who moves the prices significantly? Professional large investors who are skilled at identifying fair fundamental value of the stocks, and normally they know something that the rest of the market doesn't know, and that's why they are called informed traders. Market makers much prefer interacting with retail order flow because retail investors are neither fast nor smart enough to be harmful for market makers. So market makers can afford to set tighter spread when interacting with retail flow. So not only they don't disadvantage retail traders, they can actually provide price improvement versus displayed and BBO. Of course, retail traders could receive even more of a price improvement if there was a centralized marketplace where many different market makers would compete for retail orders, as opposed to just a handful of market makers having semi-exclusive relationships with a retail broker. Point being that brokers' practice of selling order flow, contrary to the common belief, doesn't really hurt retail investors, and it's definitely not the biggest reason why they tend to lose money in the market. What seems to hurt retail investors quite a bit is their addiction to gambling and lack of critical analysis. A good example of that is a recent incident with stock prices of Hertz, the car rental company. The company filed for bankruptcy in May, and then in June, their prices skyrocketed. Now, of course, the company then got delisted from the exchange and is currently going through bankruptcy. But it's not the only example of this new phenomenon in the market, where retail investors start picking up plummeting stocks of struggling companies in hopes for recovery. And for the time period, they actually do move the market in those stocks. Is dumb money really just an irrelevant noise, or is there a signal in the actions of retail traders as a crowd? Barclays and Goldman Sachs recently issued comprehensive reports on that topic. Barclays compared daily returns of S&P 500 constituents with Robinhood customer holdings since March 2020 and found that Robinhood customers moving into a stock has corresponded to lower returns rather than higher. Goldman Sachs analysts' findings were similar. They found that when there is a spike in individual investor activity in the stock, that shares typically lags behind the broader market over the next 2 weeks. There was another study, though, conducted by Bespoke Investment Group, and instead of looking at large-cap S&P 500 constituents, they looked at a bottom decile of Russell 3000, the cheapest stocks as of October last year when Charles Schwab introduced zero commission. And they found that the average share with a price in the bottom decile in October was up over 15% since, which suggests that in cheaper small-cap stocks, active gamblers' participation may actually play some role in the performance. And that might be a good opportunity for arbitrage hedge funds that trade small caps. On the other hand, that might be a problem, for example, for trade-following algorithms that can potentially catch and chase those trends from retail traders in individual stocks like Hertz. So did zero commission revolution make dumb money smart and powerful enough to actually move the market and compete with professional investors? Probably not, but there might be a signal there, and hedge funds have been trying to figure out a way to make money out of this new player at the table. Robintrack, a website that tracks Robinhood customers' holdings in real time, has seen their traffic explode in 2020, as hedge funds have been trying to get this data and identify the signal. Now, when all retail brokers offer zero commissions, and all of them sell order flow, and those who claim they don't most likely have their own internalizers, but they need to further compete for new clients. And the next step in the price competition would probably be to just pay retail investors to trade with a specific broker, which may sound like a joke, but it actually makes sense. For example, exchanges pay liquidity providers a commission rebate. And in a similar fashion, retail brokers may at some point start paying part of their revenue from retail order flow sale back to their clients, to retail traders. That will prompt brokerages to start thinking about alternative revenue streams. And given the fact that hedge funds are very interested in learning what retail traders are up to, seems like selling data to professional investors is an obvious monetization opportunity. Currently, Robinhood is so popular because it's basically a proxy for all the retail activity, as other brokers don't really share this information publicly. And they've been reluctant to sell this information to professional investors, mainly because they're concerned about private information of their clients. But private information is something hedge funds are not interested in at all. Actually, retail traders are only interesting as a crowd, and so hedge funds are after anonymized and aggregated data. And then again, if consumers are already perfectly comfortable with companies selling their credit card transaction data, their geolocation data, their online purchases information in exchange for free apps and free online services, why should it be different for the service of trading? Besides, retail traders are now actively posting their trading activity in online communities, and that phenomenon of social investing will only be further developing, and it will start gradually filling the market in on the same information that retail brokerages have. The current system of retail brokerages selling order flow to market makers actually benefits all the parties involved. Market makers make money on the spread, retail brokers make money on payments for order flow, and retail traders benefit on price improvements and zero-cost trading. Open and transparent practice of selling anonymized and aggregated data to professional investors will allow retail brokerages to maintain their profitability while competing for new customers by offering better service and more attractive terms. If you're interested in hearing more ideas on data monetization and business opportunities in the invest tech space, stay tuned for the next episode of Arcane Alpha.